Thanks so much for tuning into the trade setup. I'm Neeraj Shah. Good morning. And well, you might argue that the world markets are in a bit of not a limbo really, but just coming off a little bit, and that could put pressure. But I think there are some individual reasons why our markets could have an interesting day of trade, if you will. So first, the world markets and the US markets came off a bit in yesterday's session. I think the larger says around what's happening because of the coronavirus and whether the recovery becomes a sputtering recovery. Remember, until now, the argument is that while the Fed support remains, and the markets have done well, but the earnings growth has been very, very robust. Now, could those earnings assumptions come into question mark if indeed the virus puts a spanner in the wheels? Remember, there was some talk of how Israel, which was the first to get fully vaccinated and first to open up and first to party, is also mulling a lockdown of sorts again. So all of that puts the whole earnings picture into question mark. Net, you would argue that the bull will say that, hey, that means that the central bank support will stay for longer. I think at some point of time, the market's sentiment will get spoiled if the virus continues to play havoc. So, catch 22, really, I don't know. The other thing is, I'm not quite sure what happens because of the whole Taliban regime in Afghanistan and whether it's an isolated one which doesn't have too much of an economic impact. My guess would be a yes, but we well know what happens due to geopolitical events which are not quite forecasted well into the future. It is uncertain. Well, you can see this, for example, the Taliban and the Afghanistan currency has been the weakest on record, and it's been a free fall. The chart is, of course, inverted on the terminal, which is why you're seeing it move up, but effectively just invert it and think of it as moving down, and shows what a sharp slide down the Afghanistan currency has had. So, and not surprising, really. The question is, a weak neighbor, does it put some undue pressure on India as well individually? Remains to be seen. Anyways, the Asian markets should be having a slightly, not a rough day, but a slightly iffy day. Actually, most of them are in the green, interestingly. So as I said, iffy day. Let's wait and watch. India might have a different, so let's get the SGX Nifty. And I have my reasons why I believe that India might have a slightly different outing compared to what the US markets did. For now, it is showing a sign of a 0.25% uptick, and we'll get to the moment in a bit. First, a rewind to trade yesterday and what shaped up at the broader end of the spectrum. We all know what the Nifty and the Sensex did, so that's fine. Let's get the MOE function and let's just show you what the broader market of the Nifty 500 had in store, what the advanced decline ratio was, and what some of the individual movers did in trade. So 209 advances to 290 declines. So the number of decliners were way higher. We had a sharp fall for a bunch of stocks. Vedanta and Hindustan Zinc, for obvious reasons, came off. No dividend from Zinc really put the spanner in the wheels for Vedanta. Venki's India, 5.5% down again at 2625. There's some weakness in future retail again. Sudarshan Chemicals about 3%. So a bunch of those stocks came off. I think the winners were largely restricted around the healthcare space and Apollo Hospitals. What a fabulous two-day move it's been for that stock. So great going there. But some of the others like Max and Fortis, etc., also did reasonably okay. Aster DM on the back of Apollo's moves did really well, and individual newsmaker as well. So I think that those were the nature of the stocks that moved in trade yesterday. Spicier was up 5%. Goldman Sachs is a downgrade today, by the way, on that stock, reducing the target price to about 55. You might want to watch out for that. But the trade setup today, and the reason why I somehow believe, irrespective of how we start, that we might have some spark, is because I think banks may provide impetus. Nifty is near key resistance levels, but I think banks may provide impetus. And why? One, because of the HDFC Bank news, and if that propels the index a little bit higher. Remember, Bank Nifty, I think yesterday the texture wasn't the strongest, and there's the weekly expiry today because tomorrow is a holiday. What if some of the option positions, weekly options expiry, what if some of the option positions are forcibly put to cut, so to say, because of HDFC Bank's move alone? Remember, it's a big heavyweight on the Nifty Bank, and it may have the ability to propel the Bank Nifty higher. I'm not saying it certainly will, but I think it does have the ability to propel it higher. So let's wait and watch. By the way, we should also watch out for Nifty IT, some strong showing, and that momentum might continue for Nifty IT as well. Lastly, I think there's a lot of talk of this sugar export subsidy, which might be withdrawn from the next sugar season. I somehow, it's optically negative, viewers, but I somehow believe it may not have the potency to really trouble too much. Yes, I mean, any kind of subsidy taken away is bad news, but I think if the global sugar prices are higher, right? Indian sugar manufacturing prices are not determined by anything global. It's got to do with the cane prices out here. And if global sugar prices inch up and Indian sugar prices inch up, then Indian companies may not need the subsidy to export. So keep that in mind. It's the new season. It may not need the subsidy to export. So the impact, if any, may be limited. That's the point I'm trying to make. So let's wait and watch. By the way, while we speak about sugar and all, keep in mind cotton prices are near some 7-year highs, and therefore some of these textile companies which have cotton textile companies might have some interesting moves in the session today, the likes of Vardhaman, etc. So let's wait and watch. What about stocks to watch? Naturally, HDFC Bank. You might have been wondering, for the few of you who don't know, might have been wondering why I'm harping so much on HDFC Bank. The big move happened, or partial move happened. RBI partially lifted the embargo on HDFC Bank. It's been allowed to issue new credit cards. The bar on new digital launches will continue for now. But remember, in December 2020, RBI had placed HDFC Bank under embargo owing to digital outages. HDFC Bank was by far the leader in credit card issuances for the last 6 months. SBI cards, ICICI Bank have all gained a foothold over HDFC Bank, and I think the point was whether or not HDFC Bank can regain the foothold. Now, you may argue that it might be difficult to come back, but the fact that it now has the leeway to do what it wants to do on the credit card side is great news. And I personally believe that HDFC Bank will start off well. Now, let's tell you what Macquarie believes, right? So their rating is outperformed with the target price of 2005. They believe the market share loss will be regained, as per Macquarie, of course. It reinforces RBI's confidence partially, and therefore the next catalyst obviously is the full ban being lifted. They lost 180 basis points of market share since November 2020. Can some of this be gotten back? Macquarie believes yes, they will, and that's why the target price is also stiff. Some people may argue that the others are as agile and therefore need not necessarily mean that HDFC Bank will regain. I just believe that for a bank which has been the leader thus far, yes, it's had issues, but it's spent significantly around technology. And if it gets to do what it wants to do, then you got to give it the benefit of doubt, because it's not an in mean Sadatin bank. It is HDFC Bank, so we got to give credence to it. Arguably one of the strongest brands in India. So let's wait and watch. Has been an iffy move, but yeah, the last few days has done really well in the month of August, as has the other bank Nifty stocks. Let's wait and watch if there is more in store. Some of the other stocks in focus include a FIM, wherein I think the commentary on the con call was reasonably strong. It was a 20% up move yesterday for FIM. Let's see if there is more in store. Poonawalla Finance, but very smart long only funds have bought into the stock in the block deal yesterday. So I would reckon that Poonawalla Finance could be doing very well. So that's the other stock in focus. Kaveri Seeds, there's a board meet on 25th August to consider a proposal for buyback, may react. Canara Bank, the floor price for the QIP issue is at 155.58. Remember, we were speaking about this yesterday. And ISJEC Heavy Engineering, they've received an order for 2 gas-fired boilers from naval project in India. Recently, about a week ago, they received one more order. They are right in the thick of things, by the way, when it comes to this whole ethanol machinery manufacturing, viewers. So watch out for ISJEC. I would urge you to do your studies a little bit on ISJEC as well. Could be interesting. I thought that the report from Jefferies on IT was very interesting, so I bring it because IT's just had so good. Here's their thing. So they are talking about what will drive market share gains. So they're saying that I mean, of course, they're talking about how long will the demand uptick last, and trying to answer four key questions. So one, how long will the demand uptick last? They're saying that this growth till now illustrates that each of the robust demand environment, as each of the top IT companies expect double-digit revenue growth. What will drive market share gains? That's the key question that their summit will try to answer. What they are saying is that these IT firms have gained 3 percentage points market share over the last decade, but it's still only 5%. So imagine the scope of growth for Indian IT firms, which obviously have a cost advantage and the expertise. The concerns, if you will, that their summit will try to answer is addressing the war on talent, because I think there is a bit of a issue here. So what they're saying is on the war on talent is that the attrition has risen and the cost of hiring and retaining employees has increased sharply. And margin levers, they're saying that margin pressures are expected to persist. And that is the other thing that the summit will try to answer. The reason why I brought this is, viewers, to show you those two key numbers. And most importantly, the market share number, which is that despite the top 5 IT companies gaining market share of 3 percentage points, they're still at a measly 5%. So imagine if they continue to do that over the next decade, the kind of growth that these companies can show, the kind of high growth at high return ratios, and buybacks extinguishing equities, and therefore supply not only being limited, supply getting extinguished. And that's a big catalyst, right, for stock price performance as well. So could be interesting the next few years for large cap IT or IT at large. I will watch out for Vedanta. I'll watch out for Hindustan Zinc. I'll watch out for NMDC, since they've mentioned something about the demerger. So that's the other bit that all of us have to keep in mind. Just 3 or 4 names, and some companies where brokerages are meeting companies, including a company called RACL Geartech, wherein White Oak is going to meet them. So that could be an interesting one. Small cap auto ancillary, I checked the market cap about 525 crores. So nothing too dramatic. So a few interesting names to watch out for. Anyways, viewers, stay safe. If you're stepping out, do watch out for the bank Nifty shorts, if you will, led predominantly by HDFC Bank, but a bunch of other small stocks which are in news and should be kept an eye out for. Thanks so much for tuning in. Have a safe, profitable day ahead.